Today, we move on to our fifth video in our series on gold. Hello and welcome back to our channel. So far in this series I've been doing on gold, we've looked at why gold has performed so well in the last 20 plus years. I then highlighted 4 different ways that you can secure financial exposure to gold, and we've covered 2 of those so far. And as a reminder, these were buying physical bullion and taking delivery of it yourself, or using one of the online service providers to buy gold, who will then hold and store it for you. And in our most recent video, I talked about a company called Bullion Vault, who I've used to do this myself for many years. So now the 2 remaining ways of investing in gold left for us to cover are, firstly, buying something called a precious metals ETC or exchange traded commodity, or secondly, using something called a spread betting account to secure financial exposure to gold. So today we look at using ETCs. As many of you will know by now, ETF stands for Exchange Traded Fund. An ETF is simply a financial vehicle that trades like a share on the stock market and gives you exposure to any number of different underlying investments. I've covered ETFs in some detail in a number of our previous videos, and in particular, I looked at how to use them to invest in American or global shares in a video we published last year called How to Invest in 2024 Index Funds. So please check out that video if you haven't already. And as we've seen, ETFs have been a fantastic innovation, enabling anyone to put even very small amounts of money into thousands of companies at a time, or indeed any kind of investment that might ever occur to you. An ETC, or exchange traded commodity, is basically an ETF for commodities, as I hope makes sense. ETCs are designed to track the price of a given commodity, whether that might be gold, silver, another metal, or something like oil or gas, for example. And there are a number of reasons why you might want to invest in gold by using an ETC rather than by buying physical bullion. First, ETCs tend to have pretty low costs as compared to the spreads, storage, and other costs which can come with physical ownership. And as an aside, the spread in any financial investment is the difference between the price you can buy something and the price at which you can sell it. And you'll have encountered this spread anytime you've changed money to go on holiday. The spread for doing that is usually eye-watering, as I'm sure you're painfully aware. But when it comes to buying precious metals, it can be a few percentage points. Although for what it's worth, the spread on Bullion Vault is actually extremely low, which is something I probably should have mentioned in our last video. Anyway, if you invest in gold using an ETC, you also don't need to worry about where to keep it, or whether to insure it and how to do that, or of course the risk of theft or loss either. Using an ETC is also very convenient, in that you can buy or sell on any trading day pretty much instantly using any good stockbroker or investment platform. Bullion Vault gives you all of these advantages too, for what it's worth, but perhaps the single most important reason that you might choose to use an ETC rather than invest in physical gold in some shape or form has to do with tax. As I said at the end of our last video, if you own physical gold or use a company like Bullion Vault to buy and store it for you, you will need to think about capital gains tax, because tax will be due on any capital gains you make over and above your annual capital gains allowance when you come to sell any at some point in the future. If you invest in gold through an ETC, crucially, you can do that within an ISA account, which means you will never have to worry about capital gains tax. There's also scope to get this benefit in your pension, depending on what kind of pension you have. You will usually not be able to invest in gold through most occupational pension schemes, as they tend not to offer that kind of flexibility. But if you have a SIPP, that is a self-invested personal pension, and if you have that with the right provider, you could decide to allocate some of that to a gold ETC too. Firms like Hargreaves Lansdown and Interactive Investor, both of whom I use and I've talked about in the past, offer this option within their SIPP products. So using an ETC to secure exposure to gold can be a great way of going, and it can mean that you'll never need to pay tax on any capital gains you might make in gold over the years, if you do that within an ISA or a pension account. For what it's worth, ETCs can also be a good way to go if you want to be more of a trader with things like gold or other commodities. But I would remind you of what I've said many times before, that trading is absolutely not the same as investing and is a very difficult and specialist activity. If you want a reminder of that very important topic, the difference between trading and investing, do please check out my video on the subject from a while back. The other point I'd make about trading is that if you do want to do that, it's actually almost certainly better to use a spread betting account for all sorts of reasons, and we will be discussing that in our next video. So back to finish off on ETCs for today. If you want to go this way, the next important consideration is that you'll want to ensure that you use a physically backed ETC. And to explain that, a physically backed ETC will actually own the same amount of physical bullion as there is invested in the fund. So this means that if you buy, say, £1,000 worth of gold, then the provider will add £1,000 worth of gold to their bullion holdings within a certain time period, and usually at the end of that trading day. Theoretically, you shouldn't then have a problem monetizing your gold ownership if there's some sort of huge global crisis, which is the reason that gold bugs insist on owning physical, as I covered in our previous videos. A physically backed ETC will always own the actual physical gold that you're entitled to and have enough value in the fund to pay out as a result. Even despite this reality, many gold bugs still won't use an ETC for two main reasons. First, because in extremis, the government could legislate to confiscate gold in the system, such as would be trading in an ETC. And again, as a reminder, this has happened before. The US made gold ownership illegal for private citizens from 1933 to 1974. If your gold is held by an ETC provider, rather than, say, hidden in the bottom of your cat's litter box, there may be scope for the government to get hold of it. And secondly, your ability to get your hands on your precious metals or benefit from owning an ETC will also, of course, rely on the ETC provider's continued existence and ability to function. This is what is referred to as counterparty risk. Basically, if the company providing an ETC goes bust, people fear that they might not get their money or their gold back. And my view on both of these things is that you probably need not worry overly about either of them. If a government's going to go to the trouble of confiscating gold from an ETC provider, they will also almost certainly have made holding gold illegal. Which means that unless you're willing to actually be a criminal and risk imprisonment, which is clearly quite a big call, you would have to turn in any physical gold you own anyway. And I'm also not that worried about counterparty risk because of the size of the companies that offer these products, and arguably more important, the fact that your position will be backed by physical gold. I've written and spoken about this before, but often if a financial service provider goes bust, there's a decent chance you'll get your money back anyway because the assets you own are actually yours. So having explained what ETCs are, it's worth having a quick look at the ones available to you in the UK market that you might put in your ISA or SIPP accounts. And as you can see from this screenshot we're showing, there are lots of options in terms of ISA eligible gold ETCs that are available in the UK market. As ever, the fact that there is so much choice can be more than a little confusing and leads to analysis paralysis. To a certain extent, the easiest thing to do is just to choose one of the cheapest physically backed ETCs, given that they're all giving you essentially the same underlying investment exposure to gold. And the main ones here to mention are, firstly, the iShares Physical Gold ETC, which trades on the London Stock Exchange with the ticker SGLN.L. So you just need to type that into the search function of your platform. Also, the Invesco Physical Gold ETC, which trades with the ticker SGLP.L, or the Amundi one, which has got the ticker GLDA.L. These all have an ongoing charge figure of only 0.12%. Some of the other ones which are available are quite a bit more expensive, such as the ones from Wisdom Tree and Gold Bullion Securities. This seems largely to do with the fact that they've been around the longest, and so have a loyal following of investors who've owned them for as long as 20 years. Given that the three I've just mentioned are all offered by huge companies, I see no reason to pay considerably more to use any of the more expensive ones, even if they have been around for longer. And a final point to make about these ETC products, if only because so many people have asked me about this over the years, is to highlight the fact that you can buy physical gold ETCs that are denominated in different currencies. So people have asked if they should buy ETCs that trade in pounds or dollars, for example. And on this, my feeling is that frankly, it doesn't actually matter that much. Whatever currency the product is quoted in, it will reflect the relative value of gold in that currency. And so any small differences due to fluctuating exchange rates over time are not really worth worrying about in my view. I would repeat what I've said in our last video, that buying precious metals is a bit like buying insurance. You buy your car insurance every month for however much it costs, because if you're unlucky enough to have an accident, you will get a payout. And you buy precious metals regularly because if there is a monetary crisis or serious market volatility, you could be glad that you have them. And this is why I wouldn't worry too much about relatively minor frictional issues like which currency ETC you choose to own. The ones I mentioned earlier all trade in pounds sterling for what it's worth. So if you're interested in putting some of your ISA or SIPP money to work in gold, then you just need an account with someone who offers these products. There are plenty of options here, and as I've said a fair bit in the past, I happen to have used both Hargreaves Lansdown and Interactive Investor over the last many years. If you want to understand a bit more about them and also about some of the challenger investment platforms such as Trading 212 and Free Trade, please, by the way, do check out the key resources page on our website. You can find a link to this in the description and comments sections below. So one final question you might have here is how much to allocate to gold from your investments overall. And if you follow me for any length of time, you will hopefully know by now that I can't tell anyone how much they should or shouldn't allocate to gold or indeed to any other investment. This would veer towards personal financial advice, which I absolutely can't and don't give. And this is because the right answer to that question, such as there is one, will be a function of your very own personal circumstances, your age, your attitude to risk, your earnings, your net worth, and so on. What I can say, however, is please do check out our previous videos and my second book, Live on Less, Invest the Rest, the new edition of which was published just earlier this year, where I've covered how you might think about how to allocate between more aggressive and more defensive investments based roughly on your age. And in particular, do please check out our series of videos on how to invest so that crashes don't matter from around a year ago. So that's it for today. In our next video, we'll move on to look at spread betting. And as ever, if you want to ensure that you're one of the first to see that video and all of our future videos when they're published, please do click the subscribe and bell buttons. Please also think about subscribing to our free email service from the Plain English Finance website. And I appreciate this probably gets very boring because I say all this stuff every time, so sorry to those of you who watch these videos regularly. But if you would like to be in touch with me and hear from me more regularly than just these videos once a fortnight, please do feel free to connect with me on any or all of LinkedIn, Facebook, or X. And until next time in our next video, I wish you and yours the very best.